Wow, February was a rough month for the Indian stock market, huh? I mean, the Sensex dropped like over 4,000 points. That's kind of scary, actually.
Yeah, it was a pretty wild ride. I mean, we saw about 40 lakh rupees, that's 40 trillion rupees wiped out from the market capitalization. It's like poof, gone.
Oof, that's a lot of money disappearing. What about the Nifty 50? Did it fare any better or was it just as bad?
Actually, the Nifty 50 had its fifth straight monthly decline. That's its longest losing streak since, get this, 1996. I mean, that's a pretty long time.
Wow, that is a long time. So I guess investor sentiment is pretty low right now.
You got it. And it's not just the indices taking a hit. Trading volumes are down too, right? People are pulling back from both equity and derivatives.
Right? So less activity overall. How much less exactly?
Well, the average daily trading volume in the equity segment fell by about 13% in February, and that's a 15-month low. And compared to the average turnover in 2024, it's down a whopping 44%. So it's like the air has been let out of the balloon, you know?
A 44% drop? That's huge. So what's causing all this? Is it just market jitters or are there other factors at play?
Actually, a big part of it is the measures introduced by SEBI, the capital market regulator, back in November. They're trying to curb excessive speculation, especially from retail investors.
So they're trying to cool things down a bit. But is it working? Or is it just scaring people away?
Well, according to Nitin Kamath, the founder of Zerodha, brokers are seeing a significant drop in activity, like over 30%. He even mentioned they're seeing degrowth for the first time in 15 years. And he thinks the government might make less from securities transaction tax than they estimated.
Wow, that's a pretty big deal, impacting even government revenue. So stricter regulations, market correction, it all adds up. It sounds like the good times might be over for a bit.
It does. I mean, for the past 4 years, equity derivatives, especially options, have seen explosive growth. But that was fueled by a bull market and those weekly contracts, So it was like a party that couldn't last forever. Disclaimer, we advise investors to check with certified experts before taking any investment decisions.
Right, what goes up must come down, I guess, especially when speculative activity gets a little too wild. So, what about foreign investors? Are they sticking around or are they running for the hills?
Running, definitely running. Foreign institutional investors or FIIs withdrew a massive 22,011 crore rupees last week alone.
Yikes. That's concerning to say the least. What's driving them away?
Well, there are a few things: concerns over stretched valuations, a sell off in the US markets, and even fears about trade tariffs imposed by the US. It's like a perfect storm of factors pushing them out.
So they see better opportunities or at least less risky ones elsewhere. So February 28th, you mentioned, was a particularly bad day.
Yeah, it was brutal. The Sensex crashed 1,400 points and the Nifty 50 dipped below 22,150. I mean, it felt like everything was just plummeting.
Ouch. And I'm guessing smaller companies took a bigger hit.
You got it. The mid cap and small cap indices saw their worst month since March 2020, plunging 11% and 13% respectively. So it's like the smaller boats got rocked even harder by the waves.
Okay, so overall picture, the market took a big hit. Volumes are down, foreign investors are fleeing, and smaller companies are getting hammered. Is there any good news here? Is there a silver lining anywhere?
Well, some experts think so. Market advisory firm Merisis suggested that this downturn could be the final stage of capitulation. That sounds dramatic, right?
It does. What does capitulation even mean in this context?
It basically means that everyone who was going to sell has already sold. So the theory is that this sets the stage for a bounce back in the next 4 to 6 weeks. Like the markets hit rock bottom and can only go up from here, hopefully.
So it's a clearing the decks kind of situation, right? Getting rid of the excess and preparing for a rebound. I guess that makes sense. So what's the bottom line here? Are we headed for more pain or should we be gearing up for a recovery?
So that's the $1 million question, isn't it? A lot depends on global factors, especially what happens in the US markets and with international trade.
Right, because if foreign investors keep selling, then, things could get worse. But if it's just a technical correction, then maybe we'll see that rebound.
Exactly. It's kind of like waiting for the weather to clear. You can see the clouds, but you don't know if it's just a passing shower or a full-blown storm.
Well, I guess we'll just have to wait and see what happens. But it definitely sounds like a good time to be cautious and maybe do some research before making any big moves.
Definitely. It's always a good time to do your homework, especially when things are uncertain. And remember, don't panic sell.
Okay, that's good advice. So, to sum it all up, February was a tough month for the Indian stock market with significant drops in indices, trading volumes, and foreign investment. Stricter regulations and global factors are contributing to the downturn, but some experts believe a rebound is possible in the coming weeks. So, keep a close watch and invest wisely.
Exactly. That's a great summary. The market's like a roller coaster, right? There are ups and downs, and sometimes you just have to buckle up and ride it out.
So true. Before we continue, if you're finding this discussion helpful, please give our YouTube channel a like, share, and subscribe for more insights.
Great point. And hey, what do you think are some key indicators investors should watch to gauge the market's next move?